I'm joined today by Michael C. Rakower, founding member of Rakower Law PLLC. Our conversation will focus on demystifying SPAC litigation. We'll be discussing special purpose acquisition companies and the litigation that can arise from them, including litigation relating to SPAC warrants and a federal case Rakower Law recently brought in, which its client challenged industry practice and won at summary judgment more than $50 million. I heard that you were involved in an industry-shaping SPAC case recently, Michael. What was that case about? How is the industry shaping and what were the damages? If you could talk me through those key points.
Sure, I'd be happy to. The case concerned the exercise date of SPAC warrants and principally turned from a legal perspective on the question whether a Form S-4 filed with the SEC was sufficient as a registration statement with respect to the warrant shares, or whether a subsequent S-1 would need to be filed and rendered effective before the warrants could be exercised. It was industry shaping because the industry largely believed prior to that case that the S-1 would need to be filed before the warrants could be exercised. And the S-1 was rendered effective several weeks after the S-4 was rendered effective. So many in the industry believed that warrant holders wouldn't be able to exercise during that multi-week period. In fact, we show that the warrant holders should have been able to exercise as of following the effectiveness of the S-4 alone. And as a result of that, we won a breach of damages claim for more than $50 million for our client.
Well, that's quite substantial. So to help those who might be a little bit less expert than you, what is a SPAC and how would you define that for the layman?
Sure. A SPAC is a special purpose acquisition company. It's an entity that is formed solely for the purpose to raise capital and then find a company to purchase and bring that company that was private into the public markets.
Fantastic. And who are the key players then in the special purpose acquisition vehicle?
You have the sponsor, the investors, and the target. So the sponsor is the group that puts together the SPAC, the management team, the bankers, and the lawyers. They form an entity that they bring public, and they sell interests in that public entity through an IPO to investors. Investors buy that stock coupled with warrants, and in exchange, they give the SPAC money, which the SPAC collects through the IPO, and then deploys through an acquisition when they search for and locate a suitable target that's privately held to acquire and bring public. So you have the sponsor, the investors, and the target.
Fantastic. And what is the life cycle of a SPAC?
You have the IPO phase, the formation of the entity, the going public, the capital accumulation through the IPO. You have the target search phase where the SPAC entity is searching for an appropriate company to bring public. And then you have something called the de-SPAC, which is following the consummation of the acquisition, where the target company becomes a public entity with a growth plan, an operating budget, operating revenue, and now it's no longer a SPAC. It's no longer a special purpose acquisition company. The acquisition's been acquired. You've got a company with real earnings and real vision, and the SPAC no longer exists. So you have the SPAC, the IPO, the target company search, and then the de-SPAC.
Great, and thank you, Michael. And how would you define a PIPE investment for our listeners?
A PIPE investment is a private investment in public equity. Its purpose is to top off the SPAC for capital loss through the redemption process. So the way the SPAC works is when it goes public, the investors purchase units, which are comprised of common stock and warrants, from the SPAC, and basically the investors in return get a promise that the SPAC will acquire a company that it will bring public, and then the investors will have stock and warrants in that public company that has a true operating company. However, the SPAC investors at the time they purchase interest in the SPAC don't know whether they are going to like the target company, whether they're going to believe in its purpose and its vision. So as part of the deal, they have the option to redeem their SPAC shares and get money back prior to the acquisition of the SPAC target. When that happens, the SPAC, which raised company funds through the IPO, has to give back funds. So it's short capital that it wants and needs, including to meet certain regulatory requirements. So it goes back out to the market to PIPE investors who will put money into the company as part of an investment to give it the capital that it needs, which the company lost through the redemptions.
Yeah, I see that. That makes a lot of sense. And where does SPAC interests trade and what interests are traded when that happens?
So SPAC interests trade on the public markets, on the stock exchange. So when the company goes public, it has an IPO, and then initially, as part of the IPO, the SPAC issues what's called a unit. And the unit is comprised of a combination of common stock and warrants. And at some point, the unit with the common stock and the warrants decouples, and the common stock trades freely, and the warrants trade freely.
And where does litigation come in? Because litigation always comes in somewhere.
Well, you put your finger on it in part. When you have complex transactions, there are lots of places where disputes can arise. Certainly, they can arise at the IPO phase. They could arise at the acquisition phase. They could arise at the redemption phase. But what we focused on in our case, and what was intriguing to us because it was an issue of first impression, was with respect to the warrants and their exercise date.
The SPAC case we discussed at the top of our conversation, what sort of claims were brought there? Were these the warrant claims that you were talking about?
In that SPAC case that we were talking about, we brought a number of claims, a number of securities claims, and a breach of contract claim. All of the claims were premised upon the notion that our client was denied the right to exercise its warrants at the time it should have been. The key issues in our case related to the warrants, and they related specifically to the factors that determine exercisability of the warrants. So the three factors that would enable a warrant to be exercised in our case, and they're pretty standard across the industry in the SPAC world, are that 30 days have to have passed following the acquisition of the target. One needs to have an effective registration statement on file with the SEC concerning the warrants. And there needs to be a current prospectus on file with the SEC. So 30 days had passed, in our case, 30 days had passed following the acquisition, and the case turned on whether there was an effective registration statement with respect to the warrants, and to a lesser degree, whether there was a current prospectus on file at the time our client sought to exercise its warrants.
And so how did you show that the warrant shares were registered on the S4?
Here, we used a variety of techniques to show that the warrants were registered on the S4. First of all, the cover of the S4 itself supported our view that the warrants were registered for issue and sale on that S4. And so let me just point out briefly, the argument that the issuer was making was a somewhat technical argument. They acknowledged that the S4 registered the warrants for issuance. What they took issue with was whether the S4 also registered the underlying common stock known as warrant shares, or whether there needed to be a subsequent filing called an S1 to register the common shares into which the warrants would be exercised. We argued successfully that wasn't the case, that the S4 was sufficient to register the warrants and the underlying warrant shares that would be purchased upon exercise. So we pointed to the S4's cover page, which supported our view. We pointed to the fact that the issuer paid a registration fee for all registered securities, which included in its registration fee the warrant shares, the underlying common stock into which the warrants would be exercised. We pointed out that a legal opinion that they included within the S4 supported the position that the warrants could be not just issued, but exercised, and that the warrant shares could be freely traded upon that exercise. We pointed to SEC guidance, which was directly on point. The SEC has a complex, intricate, interwoven set of rules and regulations. So it can be difficult to unpack them, and there can be disputes over the interplay between them. But when you break it down, you peer closely, you examine them, there was guidance directly on point, indicating that when there's a continuing or delayed offering that would occur within 1 year of the filing of the effectiveness of the S4, then that security should be registered with the S4, which is exactly what the issuer actually did do. It followed the rules. So we pointed to the rules showing that the S4 was sufficient for this continuing and delayed offering. And then finally, we pointed to the issuer's S1 itself, because the S1 registered certain new securities, but in addition, it carried over the registration from the S4. And as I noted before, the S4 included a registration fee for the warrants and their underlying shares. And so when the issuer carried that registration over to the S1, it didn't pay a new registration fee. It acknowledged that it had paid it before and had registered the warrants and their warrant shares before. And so that there was nothing more for the issuer to do with respect to those warrants and their underlying shares. So in sum, we looked at the S4's cover page. We looked at the S4's registration fee. We looked at an opinion of counsel filed by the issuer. We looked at SEC guidance, and then we looked at the issuer's S1 and the fact that in filing the S1, the issuer transferred the registration from the S4 onto the S1. So we had all of that weight on our side. The issuer argued what we thought was a hyper-technical reading of the SEC's regulations and tried to argue the weight of industry precedent on its side. And I would, on that one point, we did find SEC precedent on our side, which we showed the court, in which a prior issuer had sought to include in a risk factor in its prospectus the notion that the warrants would not be exercisable following the effectiveness of the S4. This was directly on point with our case. The issuer was trying to take the position that a subsequent S1 would need to be filed before the warrant holder could exercise. And the SEC corrected that risk factor. In fact, had the issuer take it out. So we also had SEC precedent on our side.
Thanks, Michael. And how did you show that the prospectus was current?
It was current because the S4 showed the target company's financials and showed what the SPAC would look like following the de-SPAC, following the acquisition. So the public was provided full disclosure as to what the SPAC would look like following the acquisition. The only issue was the fact that after the S4 was filed, the SPAC did issue a financial statement. And so there was a question as to whether that financial statement needed to be disclosed to the marketplace. The financial statements that were prepared were material. From our point of view, those financial statements were not material, but even if they were, the method by which the marketplace should be told of those financial statements is through a prospectus supplement, otherwise known as a sticker, in which the financial statements could simply be attached, stickered to the S4 through a very simple and quick filing. The issuer had taken the position that those financial statements required the filing of an S1, which was filed later in time. But an S1 is reserved not for even a material disclosure, but something called a fundamental change in the company. It's a fundamental change in the operating nature of the company. The update on the financials doesn't warrant an S1. It's not a fundamental change. And the issuer never even met the standard to even make a showing that the financial statements were material. So the court didn't even get to the question, really, of whether the sticker would have been sufficient for disclosure of a material change, even though we think it would have been. the court basically stopped at the initial question because the issuer never even made a sufficient showing to show that there was a material change. So the court didn't even think that a sticker was necessary.
So very much as you say, in this case, it turned out to be something of a red herring. How did you prove damages?
The damages turned out to be the easiest aspect of this complex case. In essence, in a breach of contract case on a securities with a security, then the measure of damages is the stock price, this trading price at the time of the breach, less in the case of a warrant exercise issue, less the strike price for the warrants. So the stock price was trading at about $28 and change. I mean, the warrant strike price, which is typical of SPAC warrants, is $11.50. So the damages is a function of the spread between that $28 roughly at the market price, less the $11.50 strike price. There's a little bit of a true up in connection with that damages calculation relating to the purchase price of the warrants initially, but the purchase price for those warrants was very small. In our case, it was about $1. And then if the warrants were subsequently sold, in our case, our clients sold the warrants to mitigate damages. And so there's a little bit of a true up with respect to the purchase and sale of those warrants also, but that turned out to be pennies. The driving force of the damages calculation was market price less strike price.
So relatively straightforward, as you say. So what do you think the key lessons were from your SPAC warrants case, Michael?
Certainly the industry shaping lesson is that the S4 is sufficient to register the warrants and their underlying shares. So that's a critical fact because it means that warrant holders no longer need to wait until a subsequently filed S1 is rendered effective. So that's the key takeaway for sure. But another important point for all warrant holders moving forward is your talisman as it relates to the warrants is your warrant agreement. The warrant agreement governs the warrants. So if there's a question about the exercisability of the warrants, you need to turn to the warrant agreement and look at the conditions. The conditions in our case are pretty typical, but you need to look at the warrant agreement, analyze what the conditions are, see if they're met. If they're met, you are allowed to exercise.
Mm-hmm. Very good points for everyone to bear in mind. I think, as you say, a really industry shaping case. Thank you for your time, Michael. It's been a really insightful discussion, and I think for many of our listeners will really demystify SPAC litigation. Great to hear from you today.
Thank you very much. It was my pleasure to explain SPACs, litigation that arises from them, and of course, our particular case in which the client was fortunate to win $50 million in its breach claim. It's been a pleasure.
Thanks, Michael.